Okay, folks, we are in volume one of the ICT Precision Trading Concepts video series. This is part one of three. We're going to be doing very short modules on specific, concise concepts on how to implement price action in your trading and how it could be an assistance to you gaining much more consistency in the results that you're most likely striving for in your trading. So what are we going to be looking at in this volume? Well, we're going to be looking at weekly order blocks and order flow. Now, a lot of folks have been pretty excited about the release of the ICT order blocks on a daily and intraday basis, but you'll be surprised to find that this is actually occurring on all time frames, but the order blocks that's found on the weekly charts are many times overlooked by the neophyte trader and those that are quote unquote technical analysts and as it relates to trading. We're going to be looking at how utilizing the weekly order blocks and the order flow on a weekly basis can really direct your attention to low risk, high probability setups, and they're derived from the higher time frame perspectives. Now that's very important because again, if you look at the results of the retail trader as a collective whole, it's not surprising to see that the, the large magnitude of drawdown and or altogether bust that is accompanied with the new startups that enter our business of trading. Let's face it, as speculators, we have. Let's face it, as speculators, we run into a lot of adversity, and if you don't have uh, a very concise plan of action going in from the beginning, the emotional aspect of losing money and or even gaining money, because if you're a new trader, if you've ever felt that exhilarating feeling of seeing profits start moving into your account, that's just many times this is numbing as taking a loss. You don't know what to do. Should you hold for higher prices or lower prices if you're short, or should you just get out and panic and just be glad you made something? Um, there's a lot of uncertainty when it comes to trading. So when you have a clear, concise plan of what it is specifically you're looking for and why you're looking for it, it removes a lot of the uncertainty that plagues the neophyte and or new trader. If you've been trading for a long period of time, I think if you start adopting this mindset and looking at your charts with this concept in mind, I'm pretty much guarantee you're going to see a whole new level of trading that you're probably not accustomed to. Now, it's important that we reiterate, and you've seen me mention this many, many times in my either weekly updates on video form or in my commentary posted on the numerous forums that you've seen me participate in. But the large institutions and or banks are basing the majority of their trades from these charts. Okay, and these charts again referring to the weekly and or quote unquote higher time frame analysis. Again, assume for a moment that a large bank is looking to move a large block of a specific currency. Are they going to be looking at a 1 and 5 minute chart to do so? Absolutely not. They need the liquidity that the larger order blocks will present them on these higher time frame charts because their orders are so vast and so large. It's important that they have the liquidity to help facilitate their trades. Many times their orders has to be broken up into modular blocks. Now, just like us, we're looking for, hopefully, like us as a professional minded trader, we're looking for opportunities to buy at wholesale prices, okay, and sell to retail prices. We want to be able to get in like the smart money does. We want to be buying when the street money is selling, and we want to be selling when the street money is buying. It's just that simple. The way we do that is not to pretend to be smarter than we really are, not to have a false hope and trust in math-oriented indicators, as useful as they may seem in hindsight. We have to look for the telltale signs and fingerprints that's left in the charts that the smart money has in fact participated in a specific move. We've shown how that's identified in the Inner Circle Trader Scout Sniper Field Guide series. And I'm going to touch briefly on some of those central tenets in that series, but it's important, if you haven't really gone through that video series, I advise you to really don't watch this video series, because there's really not going to be any benefit to you without having the understanding that that previous series gives you. And by having that mindset coupled with what we're learning here, your trading is actually going to go to a whole new level. And I promise you, there's very few promises that I make in my materials, but I promise you, if you start implementing these three components to your trading and your analysis, you will see absolutely stunning results. Okay, I'm not promising profits. Notice I didn't say that. You're going to see stunning results. Okay, and in your understanding of the market, on your understanding on when price should be moving. Okay, so don't take me out of context. Okay, because it's important that I don't promise you wealth. I don't promise you profits. You're going to still lose money trading this way. Okay, so don't let me also sugarcoat it so much that you think that now all of a sudden you're going to walk out and money's going to shoot from your hindsight. Okay, I mean your backside, and everything's going to be roses, and you got nothing to worry about. You're certainly going to have your fair share of losses still, because there is going to be a certain measure of human error that's going to plague your trading regardless. Okay, no matter how concise we have our trading plan, it's still going to be driven by us as the trader, and we're only going to be as good as the trader behind the trade selection. Now, trends and order flow, these on the weekly charts, okay, they tend to remain for a long period of time. And with that, it also requires much more in terms of change to make them go the other direction. Okay, so what do I mean by that? Basically, if you see the market moving on a weekly chart higher, it's going to take a very significant impact of some sort on a fundamental level to cause this underlying trend, okay, to change course. Now that's advantageous to us, because even if we're a day trader or a scalper, okay, short-term trader or swing trader or even a position trader, these benefit us in terms of trusting our directional bias. Okay, there's no greater directional bias to trust your trades on than the weekly chart. Now the problem with that is we've been lulled into believing that the weekly charts are really of no use to us unless we're a long-term position trader. And that, my friends, is absolutely not true. If you go to majority of the textbooks, you'll see that very, very few even comment on the importance or even the utilization of a weekly chart. Now the weekly chart, I grant, it will take a long period of time for specific trades to set up on that time frame. But there's also a specific understanding. Once you adopt it, you can really walk away from the weekly chart after looking at it for just less than 2 minutes. You know right away what specifically the smart money is actually doing right then and now. Now, I don't know what that means to you, but as a trader, when I was developing, that's exactly what I was looking for. I needed to know what the guys that knew what was going to happen ahead of time. Okay, the ones that were successful. Let's rephrase that. The ones that were consistently profitable, able to harvest real money out of the marketplace. Okay, those participants, what were they doing, and how were they arriving at that foresight before putting on their trades? If I could learn that, if I could implement that in my own trading, then I could trust the effects of consistency going forward in my trading, and not just attribute it to just, blind luck. Okay, which I think honestly the majority of new traders that get into this business and make money right away with no real understanding, it it really tricks you into thinking you're smarter than you really are. And that really actually happened to me as a trader. In the mid 90s, I got involved in trading and actually caught a really good lick in the market where everything was just going up in the commodity market. So because I was a buyer, naturally it just goes it goes without saying, if the market was going to go higher, and I'm a buyer because I didn't understand shorting at the time as a neophyte trader, everything I was getting into made money. So suddenly I'm a smart guy from Middle River, Maryland, and I don't know anything really, have no idea what I was doing, but I was making money. So therefore, you think you're smarter than you really are, and then suddenly the move is, fizzled out and now it moved into a a trader's market, I couldn't do anything to make money then, and then I had to go back to my their learning. Okay, I had to go to school, if you will. Well, this is one of the concepts that you're going to learn that helped me gain a greater understanding on how these markets move on a general, and how you can really learn to anticipate sizable, sustainable moves in a directional premise. If I could take one specific question that's emailed to me more than any other, is how do I get the direction right more times than not? And I'm going to promise you that these three components that I'm giving you in this series are really the backbone to that. Okay, how do I know where the direction of the market's going to go, and why, why do I think that, and why do I believe that wholeheartedly to put my name out there, associated with an analysis on a weekly basis? Well, it's because I trust that I am limited in my capacity of knowing the fundamentals behind these moves. I don't have trained accredited staff, working, umpteen hours a day trying to find out what it is driving the marketplace. Frankly, I don't really care, okay, because I'm of the opinion and completely comfortable admitting that a lot of the fundamentals go completely over my head. Okay, I'm not a mental genius. Okay, I'm not trying to state that I'm smarter than 90% of the people out there in the marketplace. I just know what it is that makes me tick as a trader, and I combine that with central tenets in the marketplace that are inherently generic, that repeat over and over and over again. And the brilliant thing is, and the only real reason why you're learning it from me, because if I believed in my heart that if I shared it with everybody, that it would stop working, you would have never learned this. You would have never learned any of the things that I do, because it's my business to be profitable. I don't have a job. I don't go to a place of business and punch a time card. I don't collect a salary check from someplace. Okay, my income is derived by the choices I make based on a price chart. So having that as a precursor to whether you make money or not make money, okay, it's advantageous for you to really have a clear, concise approach to what it is you're doing in the marketplace. So remember that. Make that a note in your little book of notes that you may be taking with this video series. If you're contemplating quitting your job because you put $5,000 in an account, okay, I can tell you this. Regardless of how well you may be doing in a demo account with these concepts, there's a huge paradigm shift that takes place when you start realizing that if you quit your job, if you've walked away from the marketplace in terms of earning an income, and you are solely expecting every facet of your income to come from the choices you make looking at a price chart, I guarantee you, you want to talk about a mind scramble, that's what's going to happen. Okay, you're going to have such an influx of uncertainty come over you, because think about it. You've walked away from your paycheck, you've walked away from your job. Okay, so now you're out there, you're standing in the arena, and I'm sorry, I'm not looking to give you my money, and neither are any of the other professionals in this marketplace. You're going to have to take it from me, and I'm talking with a fight. And long and short of it is, if you have this mindset going in, and you've eased your way out of a job and earned your ability to make money, then being able to trade full time, it's possible. I'm not saying it's going to guarantee everybody can do it, but it's more conducive to you to be able to see a long-term lasting success in doing that. But I'm kind of deviating here, so I'm trying to bring it back. The main thing is, by having this perspective and it's an approach to trading, okay, it's really going to stack the odds in your favor and lessen, not remove entirely, lessen the likelihood of you going bust. Okay, hopefully if you have money management training, and you know that you shouldn't be risking too much on your trades, and that goes with this as well. Just simply because it works really good doesn't mean go out there and bet the farm and say, okay, well, this worked the last 80 times it happened, so therefore I'm going to put 20% of my account up and leverage 400 to 1 and see what happens, and hopefully I can get out of my job in 6 weeks. If you're going to do that, okay, I promise you, you will be regretting it. Okay, I don't want to see a testimony emailed to me about that. I'm not impressed by that. Okay, because as far as I'm concerned, that's lottery, and I don't believe in the lottery. If I believed in the lottery, I'd be putting thousands of dollars in every week trying to win the Mega Million, and trying to win the Mega Million and the big Powerball games. I'm not a gambler. Okay, so you shouldn't be either. You want to be consistently taking money out of the marketplace, and this is one concept that will help you know what it is specifically that you're looking for when you sit down at the charts. Okay, the main thing is the main thing. You want to keep your sight set on what it is that matters most, and all of the lower time frame static noise, you want to kind of filter all that out. And how is it that we as professionals do that is that we have a higher time frame perspective in mind. Simply because the market moves 20 pips one direction on a 5-minute chart or a 15-minute chart means absolutely nothing to a longer, higher time frame premise. What I mean by that, I could watch an intraday price chart and see many times where the market would pay 20-30 pips, and it would be against my directional premise or my comfort zone in terms of directional premise, because I'm willing to wait for the setup to come to me. I don't want to chase all these little tiny minor moves in the marketplace. There's people that can do a very good living doing that and scalping the market and short-term intraday trading. I'm not negating their ability to do that or your potential to do that as well, but that's not the crux of this presentation or this series. This is really designed for those that are asking the questions like, well, how do I know that the support and resistance level is going to hold? How do I know that the directional premise for this day is going to be what it should be? Okay, this is my answer to those questions. Okay, because like I said, if I could go back to one question, how is it that I'm able to get the direction right? The second most asked question is, how do I know that a specific support or resistance level is going to hold? And we're going to be able to focus on that specific pair of questions in this individual volume. And then in volume 2 and 3, we'll be dealing with other topics that will hopefully dovetail nicely with this one, and hopefully improve upon your understanding of the marketplace. Now, framing retail trading ideas on the basis of the macro perspective is conducive for profits. And again, we've already said this briefly. If you don't have the understanding of where the fundamentals are behind the market moves, okay, and again, I don't claim to be a fundamentalist. I don't know what the fundamentals are. I can't digest bank reports. I know a lot of well-known trading mentors out there use them and share them openly. I don't have the capacity to look at that stuff and understand what it means. Okay, and I don't have any shame in telling you that. I can't listen to a speaker and determine, oh, that's hawkish or that's dovish. I don't understand that. Okay, and if you can, wonderful. Kudos for you. But I don't need to know all that stuff because I trust the price chart to tell me everything fundamental that I need to know about that marketplace. If it's looking to move up higher, I'll see signs before it starts going up that it's going to go up. And I'll attribute the fact that it's making money for me that I was fundamentally right on that move. That's the limitation I have as it relates to fundamentals, okay? Aside from interest rates, obviously. Now, the EMAs, or the exponential moving averages, applied to the weekly time frames will assist in higher odds order flow and order blocks. Now, what do I mean by that? When we apply the 9 and 18 EMA on the weekly chart, we already mentioned briefly that there is a huge tendency, okay, for trends or order flow to remain intact on a weekly chart. In other words, whatever it was that established the market moving higher, generally it's going to take something of greater magnitude on the opposite end to make it go lower. Okay, so as long as it's viewed as a good buy, the market will continue to move higher and continuously make higher highs and higher lows. The wonderful thing about that is that even though the EMAs are lagging in terms of time, okay, they're very low reaction. Okay, it takes a long time for these things to turn around on a weekly chart. As a new trader, if you sit down to a chart, no matter what pair you look at, or if it's a stock, or if it's an index, or if it's a commodity, if you look at a weekly chart and you lay over that particular time frame a 9 EMA and 18 EMA, if the 9 EMA is greater than the 18 and they're stacking, it means they're opening up, okay, they're widening from one another and pointing up. That's all we need to view a potential bullish condition on a weekly time frame. In other words, weekly order flow would be considered up. Okay, it's that simple. And conversely, if the 9 EMA is below the 18 EMA and they're stacking, in other words, the averages are opening up and pointing down, okay, that is all that we need to indicate that we are in a weekly bearish order flow. Okay, now obviously there will be times of transition where we move from a bullish to bearish or bearish to bullish, okay, or we may move into a larger consolidation period. That's going to happen. That is where you're going to incur your losses. Okay, I'm not saying you won't lose money in a bullish condition being a buyer. Okay, there's going to be times where you're going to, just simply be wrong. Okay, but if you stick to that approach, if you consistently milk that approach or perspective in the marketplace and focusing on the strongest, most likely tendency to move higher or lower based on this time frame, your trades, there won't be many of them, okay, because we know where we look to buy, we know when we look to buy, okay, but now we're going to be looking specifically on what direction where we're going to be doing predominantly the most buying or selling. And by having that in our arsenal of tools, we'll be able to remove a lot of emotion, we'll remove a lot of the fear, okay. And think about it, think about what this does. Assume for a moment you have a bullish weekly order flow and everything's moving higher. If you find a daily order block to be a buyer, when you buy into that and it rallies up 20 pips and it starts to pull back 10, are you going to be scared that you probably made the wrong decision being a buyer, or that it's going to come down and take your stop? Probably not. Or hopefully, it's my advice that you shouldn't be fearful of that, because you're going to be trading with the professional mindset. Okay, you're going to have the higher time frame, you're going to have the weekly order flow, you're going to have weekly order blocks, you're going to have daily order blocks, all in favor. And if you start timing the trades around markets open and closes, you have so many qualifiers that really move the odds of you making money into to reality. There's simply no guarantee. Obviously, I can't guarantee you're going to be consistently always making money, but if you just get a little niche in this marketplace, a small little edge, okay, and you understand what that edge is, you can maximize this, okay, to be as big as you want it to be in terms of your results. But also, it's a double-edged sword. If you maximize the risk simply because you associate the consistency to it, okay, you're going to have a loss. And invariably, if you take a loss, that invites emotionalism, it invites fear and greed. And then when you start applying those things to your trading, everything goes out the window, and now you have havoc, okay, wreaking havoc all over your trades. You won't have any understanding of what it is you're doing. You're going to be reactionary instead of anticipatory, and that's problematic, okay? So we're going to be looking at the advantageous nature of having the EMAs on a weekly time frame, okay, and how these will help us stay focused on where the fundamentals are driving price, okay, where the momentum, if you will, is continuously pushing behind the marketplace. And by having that, we'll be able to be much more relaxed. We won't be rushed. We'll be waiting for the market to come to us versus we chasing it and missing the ideal low risk, high probability entry points. Now, trading in line with this view will greatly increase the likelihood of consistency and precision. A lot of the times when I share my charts on a live basis, I get a lot of response that, that was crazy. That was insane how, the market reacted exactly right where you were calling it to do it. And I gotta tell you, this comes with experience. I mean, we're talking about a gentleman, okay, myself here. I've been doing this for 2 decades. Okay, that's 20 years. A lot of the guys that I talk to are actually, not many more years above that in terms of their age. So if you think you're just going to sit down and watch this video series, take a couple notes and plug in a demo account, and then a month from now you're going to be hitting it. It's going to take a little bit of time, guys. And I would be foolish not to advise you to at least expect, again, a growth period of at least 6 months. You gotta have to see these things happen to learn to trust them. Hindsight and back testing is great, okay, that's wonderful, but it's an altogether different animal when you start applying it and putting your money or even a demo account or pride on the line, placing trades based on these concepts. You have to have the understanding that we're dealing with probabilities here. We're not dealing with certainties. We're not dealing with absolutions. Okay, if there's any absolution, it is that if you're wrong, you're going to lose money. It's going to come out of your account. There's no guarantee there's money coming in, but if you're wrong and you don't know what you're doing and you grossly abuse leverage and risk, you will lose a lot of money. Okay, it doesn't matter that these have been tested by a trader that's been doing it for 20 years. It doesn't matter that I've made X amount of money trading it. It has absolutely nothing to do with it. My results are absolutely unique to me. Okay, just as well as your results are going to be unique to you. I have a lot of people reading the material that I present freely on the internet. Why is it that every one of us have completely unique results? Think about that. We're all uniquely different. I may see something on the chart that you don't. Now, pundits and those that attack mentors and trading advisors or teachers or someone that's sharing ideas, okay, they'll come in and be argumentative and say, look, if your stuff works so well, why isn't everyone else doing the same thing that you are? And that kind of like proves their myopic approach to looking at things. Okay, it doesn't matter that we're talking about trading. Why isn't that everybody that gets in golf doesn't play like Tiger Woods? Okay, why isn't it that everybody that gets into basketball, why aren't they able to play like Michael Jordan? Okay, it kind of falls on its face when you really look at it for what it is. Okay, so don't judge your development against me as the mentor. Okay, you judge your development against how you were the day before, and you consistently do this over and over and over again. By default, you will improve. That does not equate to profitability. That comes on its own timing. I can't promise you that, but I can promise you you will know more about you and how you are going to interact and engage this marketplace by these concepts, and that what we already learned in the previous videos and teachings that I've shared over the last 4 years. Now, with all that, let's take a look at a few examples. Okay, folks, we're looking at the Fiber weekly chart. This is the Euro USD. And I've already applied the 9 and 18 period exponential moving average. Now the blue line in here, that's going to delineate the 18, and the red line is the 9. Okay, and very simply, if the 9, in this case again the red, if it's above the blue, okay, and this again is a weekly chart, when we see this crossover and the averages start to stack, okay, and that means right about in here we're starting to see very clear indication that these averages are opening up and continually moving higher. I do not consider any of these downturns here as precursors to a potential crossover. When it crosses over, then it crosses over. Okay, it's very important you have that in your notes. A crossover really has to happen in the averages before it actually considered. I no longer want to be following that premise. Okay, again, that would be considered right here. Now the quick response is going to be, and I know I'm going to see this already on either on Twitter or I'm going to see it on the forums. And if I let comments open for my videos on YouTube, not that these are going to be on YouTube, but if they were, invariably everyone would come out and say, well, look at this big move here you missed. Okay, I agree. You would have missed this big downturn, okay, in terms of directional premise. But there's other tools that we can utilize back here for that, okay? So again, we're building an arsenal of tools, okay? We don't drive a nail with a saw. Okay, I can't say it any simpler than that. Each tool has its time and purpose. This is a tool, and I'm showing you its time and purpose. Okay, when the averages are opened up and they're stacking, again, the definition of stacking is when the averages are trending in the same direction and opening. Okay, that to me is a qualifier that we're in a bullish market condition on the higher time frame. So weekly order flow is higher. I want you to take a look at this chart. Now this is June of 2013 in this area here where we start seeing the averages open up, and we've continuously seen the weekly order flow on a higher level. Okay, in other words, it's moving bullishly. Okay, yes, there's been bearish weeks. Yes, there's been downturns. Yes, there's been wicked sell-offs. But overall, we've maintained higher highs and higher lows. Okay, So again, it helps you filter out all of that uncertainty that plagues a lot of the traders that are either reactionary or just simply have no idea what they're looking for. Before we go into the weekly order blocks, I want to kind of show you how we can apply this information. Okay, so when you see the averages opening up here, okay, we're going to use this week there, okay, and we're going to color our area like this. Okay, now you can do any color you want. Okay, but what I've done is I've mapped out the market in terms of we're in a bullish condition. Okay, so as long as the averages are like this, okay, in other words, let's just say, for instance, if this is the time of the recording that you're watching right now, I would be simply doing this, okay, with this data unknown yet. Okay, but right now as it is, we have this data, so we're just going to look at it like this. But it doesn't remove the benefit of studying it in hindsight, because someone's hindsight today is going to be your benefit and future tomorrow. And that's what I'm trying to share with you now. If you look at this and discount it immediately, I promise you, everything else I teach you, or you could do the same thing with it as well. You can nitpick it and find all kinds of flaws in it. But it's not the individual tool itself. It's the orchestration of the tools together that build a confluence of an idea that will hopefully materialize in a gain for you, either monetarily or understanding what it is that you should be doing as a trader. And I'm really focusing more on the latter than the former. So now looking at this market like this, if we break this down, and we're just simply going to go down to a 1 hour chart. We're going to cut through all the 4 hour and all the other stuff. We're going to go right to a 4 hour chart, okay? And I'm going to be looking at this time frame here, okay, since the June of last year. While we're in this shaded area, okay, we are in what would be considered a weekly bullish order flow, okay? I want you to pay attention to when we see order blocks, because you understand this already by looking at the Scout Sniper series. We see a price rally up, aggressive, okay? So in this area here, in this price, we're just going to call it 133.25, okay? When price moved aggressively away from that, okay, notice it did it rather sharply. Then we pulled back down and had a retracement. Now, if you're simply just looking at my videos and reviews, it simply looks like I'm grabbing the best of the best in terms of the highs and lows to pull my fib from, and then say, look at this move that I caught, or look at this move that you could have caught, okay, or look how great and perfect my tools are, okay. You've gleaned another important central tenet to my understanding of the marketplace by implementing the ICT order blocks. Okay, we understand how to look at the marketplace and see when institutional sponsorship enters the marketplace. Okay, the first bearish candle right here, okay, by applying our understanding that we learned in the Scout Sniper series with order blocks, when price moved back down into this area here, this order block, that is when we would be looking to be a buyer. Okay, notice also that the averages are above. Okay, the red is above. Now, we don't use the averages on a 1 hour basis, but if you're looking to utilize them, that's certainly possible here. Okay, but I guess really I should be removing I should be removing these indicators right now, because we've already arrived at our understanding of what it is specifically they're going to give us based on a weekly chart. Okay, so now we can clearly see, looking at study of price, we're in an area where we want to be focusing on buys. Okay, and by having this understanding, we could be looking to be a buyer when it gets down into a 1 hour order block. Okay, now I'm just going to quickly pan through. I'm not going to try to cherry pick anything, but you have price. We saw price drop down in here. Okay, we have a rather large order block in here. Again, we discussed why I do not like the long wicked candles in here. So you could argue that this would be one here also, but again, it looks like a spinning top. I want more candle body. Okay, so it would be this one here. Okay, so if we apply that, okay, when price drops back down into this area of order block, okay, we saw price rally in here. We saw price rally in here. It dipped in deep here, rallied again. Even this little area right in here, okay, it doesn't look like much, but that's a trade that you could take intraday. Okay, that's a favorable trade. If you pull a fib from this low to this high, sure, that would be something you could be catching a trade on. And again, all we're doing is simply looking at areas of where price action showed a potential to bounce. Okay, we're not looking at the cleanest, major swings and major, price points to take every single major high and low. That's not what I'm teaching here. I'm giving you a means of looking for consistently profitable setups over a long sample size, a long period of time, not just giving you the best of the best and cherry picking, because that's entirely two different things. Okay, that's another whole video series. But moving forward, okay, price, even though we were in this long period of drawdown in here, okay, in terms of price dropping lower and lower and lower, okay, one could argue, hey, look, I'm not able to get a trade, during this period of time. I can't see any means of looking to be a buyer in here. And that's fine, because you know what? This is just one pair of many that you have to choose from. Simply because I focus on the euro and British pound doesn't mean that you can't pay attention to other particular pairs. All I'm showing you here is if I'm in the euro, I want to be a buyer. Okay, especially if I'm going to be loading up the maximum amount of risk allocation to my trades. Okay, price, let's come back here just a little bit. We have this area consolidation, okay, support and resistance. Price rallies through it, comes back down, almost to an area of old high in here, old high as well over here, comes down, and then what does it do? It doesn't spend much time here, does it? It rallies off. Now again, focus on the big picture. We are inside of a bullish weekly order flow, okay? So we want to be seeing these types of events in here, okay? Price rallies up, and it comes back down. Where is it rallying? Was it drop down into? Previous order block right here. Okay, the bearish candle prior to the rally up. Inside the bearish candle, again, what is our understanding in the marketplace? Smart money buys in down markets and they sell in up markets. Okay, relate that to a candle. Yes, they may be buying in this candle here. Okay, but we're looking inside the bearish candle. Okay, let's zoom in a little bit better. We're looking inside this bearish candle prior to this move up. Okay, so by applying that, we can get very precise in terms of where we would anticipate seeing a market move higher. Okay, we have a smaller order block here as well. Okay, we saw price come down into our larger order block here. Price rallies, okay, it comes back, and where's it come back to? The previous order block right in here. So here's another opportunity to be in here being a buyer. Look how precise these areas of bullish order blocks inside of this larger weekly order flow that's bullish. Look at the reaction you're getting. Okay, and I want you to pay attention to the dates at the bottom of the chart, because you're going to see how many times these setups present themselves. Okay, we have another bearish order block right in here, or we could use the order block. Okay, it comes down, certainly down into it there, but we're going to be a realist and we're going to say that you're utilizing this candle here. I don't like this one because it's too wicky. Okay, so I would be willing to be a buyer once we broke below the candle's high here. Okay, not, in other words, yes, this candle's high is lower than this one. Okay, so ideally the risk would be smaller by utilizing this one, but I want to be sticking to my rules. The rules require a little bit more of a body on the down candle in a bullish order block. So I'll be utilizing this one. So the price comes down in here. Okay, the close on this candle, let me see if I can get it to pull up. Well, it's giving me a hard time now, but it's not much in terms of decline. Yeah, we just had it. All right, we'll have to move on. The price comes back down into this order block, and what does it do? It snaps back up again, okay, and rallies. What I find interesting is, okay, that price not only comes down into it here, rallies off, okay, but comes back down into it again inside the same order block, okay, rallies off again, comes back down one more time. And when you see this, okay, they're really accumulating positions in here, okay? They're really accumulating positions. Now, this is going to answer one of the questions I get a lot. How do I know that price is going to hold a support level? Okay, well, we have a bullish order block here. Okay, and now what we're going to do is add a horizontal line. And I think everyone that's watching would agree that this is probably a good level to choose. We're just going to use a 60. Nice round number. We find this support here, we find support here, we find support here, and then we rallied off. Okay, when you see the level being accumulated like this inside of an order block, inside of a weekly bullish order flow, okay, that's how I trust the level to be a support level and not be violated. Okay, now again, because we trade in the gray, in other words, we don't trade with the perfection of black and white. We have to trade in between that. Okay, and it's going to be a lot of times unclear, but we trust our understanding of what the marketplace gives us over a large sample size of doing the same thing over and over and over again, building a reference point of trust in the tools. Okay, again, this is the reason why you simply can't watch these videos and go out and start making 32% a month. Okay, it's not going to happen like that. You're going to have to spend some time warming up to the tools, owning them, making them your own. Okay, but this is the framework that I utilize to trust a support level. If the order blocks are being respected on the bullish side, support levels around that order block should maintain. Okay, it's just that simple. There's no real voodoo to it. Price rallies up strongly, and you can see we had more of a consolidation here. And again, back here we saw that support level that we have identified here, okay, that we expect this to be a solid support line and should maintain price above it. And you see a very huge extrapolated move on the upside. Okay, now think, we're seeing the biggest moves with the shortest amount of time happening going lower or going higher? Going higher. Okay, the order blocks on the bullish side of the marketplace is being respected a great deal, and that's what you're looking for. That's behind the peels of the onion that you're looking for. You're investigating, not only trading the market, you're investigating on a daily basis what's being respected. Okay, if we're on a weekly order block, and I'm sorry, a weekly order flow that's bullish, and we have order blocks on the daily, the 4-hour and 1-hour chart being respected, how would you ever feel comfortable going short in that condition? Why would you want to do that? Even if you're a day trader, why would you want to do that? It just goes against the grain. Why would you do that? Hopefully with this video series and the previous with the sniper series, you'll see that going against the grain many times is just not worth it. Even if it's, because you see something that you've missed on the long side. Well, I want to be a seller because I missed a big move, so I can catch me a little bit of retracement. Why? Why not just sit back and turn the computers off, go watch a movie, go read a book, go spend time with your spouse or kids, and then come back and wait for when the market participants are lining up the next move going higher with a bullish order block inside this weekly order flow that's bullish. Okay? It gives you that patience factor that's so hard to grab a hold of as a new trader. That skill set is learned by just getting in the marketplace and doing it. And really, the patience is honed by the not doing it, okay, to doing the lack thereof of doing it, okay, if you will. So we have price again giving us one more opportunity. Now again, I'm showing you a completely naked approach. I just gave you one example how I classify and qualify a support level or resistance level, same way, just reversing it. But we're looking at pure naked trading. Absolutely no indicators, absolutely no Fibonacci, no pivots, no none of that stuff. Okay, I want you to look at the inherent nature. Price behavior repeats over and over and over again. Okay, price comes down, rallies off sharply. Okay, So if you sat down at the chart and say, wow, look at this, this is really running up. Many times the new trader will say, look at this, we're making a bull flag, I'm going to buy. They'll buy expecting the repeat of this move to here to be replicated here and go up higher. It didn't do it here. You as a professional trader will say, hey, you know what? I've watched Inner Circle Trader's Scout Sniper series, and I've now watched his new Precision Concepts series. I know this up here, these are inflated prices. I'm not paying inflated prices. Okay, I'm not willing to do that. I want to sit back and get a better deal on being a buyer. Okay, because think about it. If this is your point of origin down here, okay, this is where the market took off. Inside this bearish candle is where all the smart money was buying. Granted, they may have been buying more here, but I promise you the majority of their buy order was facilitated during this bearish candle. Probably, if not, if at all, majority of it being in the lower third of the candle itself. So if you look at the order block, we add that here to the high of the first bearish candle going right before the moves begin. Market drops back down inside of that. Okay, and again, I'm not going to apply any Fibonacci's here, guys. I want this to be pure and simply focused on the price action alone. I don't want to have any kind of muddled charts. I don't want to look like I'm cherry picking and making it look perfect for you. I'm showing you what it is that you're looking for, why you're looking for it, when you're looking for it. Okay, again, don't lose sight that we're in this larger gray shaded area where what? The weekly order flow is bullish. Okay, I could care less if I'm going to be a short-term trader or if I'm going to be an intraday swing trader. This is the type of setup that you're looking for. Okay, price comes back down, and what are you going to look for? The order block to be fulfilled as a buy right in here. We dipped back down inside of this. Okay, you can pull your fib from here to here. Look on your daily pivots. Look for some confluence of supporting factors around here. But we're also trading about what level? The 134.80 level. That's an institutional level. That's one we like to see. Okay, price bounces off of that, comes back down one more time, dips into this order block. Now we're going to scroll forward and see. You think that's a price reaction that's worthy of your attention? Again, we're looking at just simply looking at weekly order flow as a framework of determining where we should be doing our buying or selling. Okay, and by having that, we're limiting our focus really only on one side of the marketplace. We won't be lulled into thinking we need to be a bear, and we're okay with price moves dropping lower. Okay, because that's doing what for us? It's setting up a next potential buy. Okay, and that's a very handsome move right here. I mean that's a decent move. That's what is that? It's 10, 20, 30, 40, 50, 60, 70, 80, almost 90 pips made available to you just simply using this concept of understanding higher time frame order flow, looking for order blocks on a lower time frame to support the idea of buying. Okay, but more importantly, that it goes along with our title of the series. Look how precise. Okay, look how precise these reactions are occurring, exactly where we're expecting them to see. I'm going to show you. I'm going to give you a view on how much this is our order block. Okay, and it dipped down to the tune of, well, look at that, 5 pips. It only moved 5 pips into the order block. Okay, so that means if you're buying inside this order block and you're going to just put a stop below here, we're going to say 10 pips. I'm going to be fair. I could say 5 pips, but I don't want it to be too perfect. We're going to say we're buying right at the order block. Okay, so in other words, we're going to allow the marketplace to trade to this point, and it's got to go at least, I guess the general mean is about 3 pips for most retail platforms. But if you're buying down here, you're going to get your fill. Here's the low, and we go 10 pips below that. Your stop's around 134.50. Okay, so that's not bad. I mean, that's less than a 30 pip stop. That's 21 pips to get this type of move. So who out in the audience would say, pardon my expression, but screw you, ICT. I don't want to make 90 pips and risk 25. how dare you ask me something like that? Yeah, that's the mindset that you should be adopting, okay, going into this, because when you're looking for 3-to-1 setups like this, it really perpetuates your equity curve to higher heights than you probably have ever expected to be able to see. Also, again, I can't stress the level of confidence that you have as a trader when you apply these concepts routinely. You stay within the rules of what they are requiring you to do, and by looking at the marketplace with an understanding of what it is you're doing, why you're doing it, and the times of the day that you're expecting these things to occur as well. Okay, so again, I'm not trying to give you the whole you know, recanting of the sniper series here, but go back through that video series. If you've gone through it once or twice, do it again, and then come back to this video series one more time, and I promise you the ideas will dovetail so uniformly. When you look at the price charts, you're going to absolutely fall off your chair and say, you know what, man, this has been right here the whole time staring me in the face, but you don't understand it. It's like reading music. Okay, I couldn't read music to save my life. Okay, I have a son that plays the trombone. Why he picked that instrument, I don't know, but he can read sheets of music, and to me, it looks like it's in hieroglyphic form. I can't get anything out of that stuff, but he can look at his sheets. Oh yes, it's do 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 do, and he starts playing it right away. Well, when you look at the price charts, okay, uh, Linda, from the book Street Smarts, made a very good analogy. She plays the piano, and she views the marketplace as like reading musical notes. Okay, and she knows how to interpret what it is that price charts are, you know, communicating to her. To me, I just look at price, how I communicate to you. I adopted this sniper persona, not because it sounds cool and I'm a guy. It just happens to be a bonus. But to me, it just makes perfect sense. I lie in wait. I want to see price come to me. When that prey steps into my scope, it's going down. Okay, I might have to shoot one more time to ultimately get it. Okay, but I'm going to shoot nonetheless when it steps into my scope. I'm not panning all around with my scope. Okay, I'm waiting for it to come out in the clear at a specific time because I've done my reconnaissance. I've waited for this thing to drop down. Okay, I've waited for it to come down into a time where it's shown a pattern to repeatedly come back to over and over again, like a mouse going to cheese. Okay, when it comes down to this time frame and it enters what time frame of the day? This is during the London close. This is a time frame where we expect things to happen. Okay, so when you see that, there's a reason to expect the markets to do something, not simply because, well, I got off of work early, or I faked like I was sick and got a stomach flu. My boss thinks I'm going to bed, but I'm really going home to trade the British pound because the last video I saw just has me so stoked and I need to make some extra money. That's no way to trade. That's no way to go into this business. Okay, again, you want to be completely focused as to what it is you're doing, why you're doing it, when you're doing it, with a premise behind it that is unmovable, regardless of what I say in the forums, what I say in my videos, what I say in my commentary, what anybody else says. It doesn't matter who they are. Okay? It does not matter. You are unwavering in your analysis. You stick to it. That's when you move to a whole new level of trading where it just can't be understood until you get to that point. When you arrive at that level, you'll know exactly what it means to be completely confident and unshaken. Now, it doesn't mean you're trading with 100% accuracy. It just means that when your loss comes, it doesn't affect you because number one, you know that they're going to be minimal. They're going to be controlled. They're going to be at the lower spectrum of overall risk to your asset. I'm sorry, your equity. So in other words, you have limited it to a total percentage. You've totally limited it to the number or frequency of trading. You've limited it to the degree that you're only going to be focusing on one side of the marketplace. You're only going to be doing specific trades at a specific time of day, a specific day of the week, because we don't like to trade on Mondays, we don't like to trade on Sundays, and we don't like to trade on Fridays. We've really focused on the sweet spot, if you will, to cherry pick Tuesday, Wednesday, and Thursday setups. Okay? Now, it doesn't mean you can't take a Monday trade. It doesn't mean you can't take a trade on Friday. But I certainly advise you not to take a trade on Sunday because there's simply not enough liquidity to facilitate sound trading. let's continue to move on. I'm going down another rabbit trail. I apologize. I'm very passionate about this stuff. Obviously, you can hear that in my delivery every time I get in here and start teaching versus just doing a market review. But we have this order block as well. Price comes back down into this order block, and we could borrow this level here, make another copy of our little trend line here, and add it to our bearish candle of our bullish order block. Again, we're looking for the speed at which it moves away from the level. This is a qualifier for these, okay? And we're also looking at the time at which it's spent at that, okay? If it's meandering around, okay, it's meandering around long period of time, okay, that's not a lot of institutional buying that you're going to be able to measure. Okay, you won't be able to see that as a footprint in a chart, if you will, of smart money. This is an elephant footprint. Okay, but we're already established in a long position, so we expected this. Okay, price drops back down. Where does it drop into? Previous order block. Okay, boom. Not much in terms of movement below that trend line. Okay, delineating our order block, and price rallies off again. Okay, so just in a quick span of 15 minutes, we've shown several opportunities in a short period of time, very consistent, very aggressive, very explosive price moves on the upside, just focusing on what side of the market. Remember, we're inside this shaded area. The shaded area is indicating what? We are in a weekly bullish order flow. Again, we're trusting the fact that the weekly order flow is going to stay intact. Yes, we're willing to allow the market to drop down, but we view every decline as a potential buying opportunity. If it qualifies time and price theory, if it qualifies, goes into a daily 4-hour or 1-hour order block that's bullish, okay? See how these things start to dovetail? You'll start understanding it when you see it over and over again. It's simply just not enough me showing you the examples in hindsight like this. When you start seeing it in real time, it's amazing how fast your understanding grows exponentially because you're actually putting these concepts to practice. Okay? We have another decline in here. Okay? And where's it dip down into? A previous order block right in here. Let's borrow this level. Okay, right here on the high, price comes right down into that level, boom. Okay, now again, this is the reason why you have to always incorporate the spread. You have to do that. Okay, and I'm resisting the urge to that. Just really wanted to grab a Fibonacci just to justify this setup here, but I'm going to refrain from doing that. You can do that in your own charts. Okay, but looking at the overall price structure, okay, from low to high, you'll see all of what you need to see in here in terms of developing the entry point for this particular setup if you were looking to trade it. I'm going to ask you real quick, look to the right, and what price level is this reaction occurring at? That's correct. It's at the 135 big figure. Okay, right in here. Boom. And it blasts off. Now again, this is what I want you to really walk away from this module with. Yes, price moves from this high down to this low. Okay, granted, those that were indicating bearishness up here, it maybe went short up here. Okay, it rode this down. Sure, wonderful. I applaud you. Okay, it was slow, it was meandering. It eventually got down to it. Okay, but eventually, what happened? Boom! The professional stepped in and did what? Bought the bargain pricing. Okay, just like they did down here. Price dropped down into a bargain. Boom! Took off. Price dropped down lower. Boom! Took off. Okay, these declines are not retail sellers pushing the market lower. Okay, here's a little nugget for you to keep in your notes. When you're in a bullish condition, okay, expecting higher prices, when you see prices dropping lower, okay, that's not indicative of smart money selling. In fact, it's a contrary. It's the lack of smart money buying. Okay, retail market traders do not move the marketplace. Okay, we're just fleas on the big dogs. This price action is inherently directly related to the absence of large institutional buying, much in the same capacity you see here, here, and here. Okay, so when you see declining markets when it's overall bullish, as we've outlined here, again, these should be like red neon signs flashing. Hello, hello, are you paying attention? Okay, because this is about to go up, and you need to be looking for the institutional order block that this next price swing should be anchored to. Okay, and we're going to talk more about that when we get into the second module in this series. But for now, let's continue moving forward. Okay, we have a bullish order block in here. Price didn't spend much time here. It takes off, rallies, okay, and drops back down into what? The previous order block. And we have a nice little pop in the marketplace right in here. Okay, and eventually we move back into a decline in the marketplace. Again, there's no more new buying up in here. So what's going to happen? The market's going to reprice and go lower. Okay, now a neophyte will see this and say, man, look at this thing. This is going straight to hell. I'm going to go in here and sell the maximum amount of money that my account will permit me to do. Okay, and because they saw this big bearish candle, okay, and they want to chase it because they're thinking this is some kind of a high. Okay, or they watched my video or read Street Smarts and said this is that 3 and then pattern, and last time I did that it moved 1,000 points, so I'm going to go short and bet the farm. Okay, you as a professional should not be thinking that. Okay, what are you going to be doing? You're going to expect the market to move again higher, moving from a bearish tone to bullish tone. Okay, we moved into a bullish order block right here. Did not dip into it. Okay, we did eventually trade down into it here, right in here, but there's nothing really to base this on. We had a consolidation, okay, which means below here would be stops, okay, and we talked about this in the the sniper series, where if we have a consolidation like this, okay, the dealers are working both sides of the range, and what they're looking for is eventually there's going to be an imbalance of buys and sells, okay, and wherever the most liquidity is to be harvested from. In other words, the path of least resistance. Let's just call it that. We've seen the market rallying. Stops would be below this low here. Okay, so yes, there's a small pocket of stops below here, but really it's this point right here. Okay, so eventually the market will dip down below as we see here. And let me drop back a little bit so you can see. This is that low I was just referring to, and this is the 2 points of reference that we talked about. And it's that previous order block. Yes, we eventually traded down into it, but this is too much of a break in market structure, okay, to facilitate not at least waiting for this market to come down, at least run these stops, or maybe even a lower level stop area. Okay, and price comes down into that level, rallies one more time, and again we move back into an area where we start hunting bullish order blocks. Here's one in here where price rallies up sharply, comes back down into the previous bearish candle, rallies one more time. We have another one in here. We have the price rallying up, the bearish candle prior to it, where the smart money would be indicative of the bull camp. We could be placing that right there. It'd be nice if I left it there when I dropped it. Price comes down into that order block again, and what does it do? It rallies off sharply. Okay, we have another one in here. Bearish candle, price rallies up, drops back down into this previous order block, rallies one more time. Okay, and again, these are like 50 pip moves, guys. I mean, these aren't little, 10 pip, 5 pip, one-hit wonders. These are something you can build careers off of on a one-shot, one-kill basis. If you catch just one of these a week with the right amount of equity management, you can build a career on this. Okay, and it's important that you understand that, because a lot of guys trade just simply fixed percentage of account trading. In other words, they only have a certain number of lots always on. They don't do anything more than that. Okay, and there's no reason why you should fear compounding your returns. If you understand what it is you're doing, it just takes a short period of time, 18 to 24 months. You can't even imagine what that does numerically to an equity curve. If you're properly positioned each time and keeping your risk small, aiming for 3-to-1 setups, it's absolutely, astonishing what you can do. Market breaks down, okay, and we don't really have anything here without going to a higher time frame, okay, but I'm going to stick within this 1 hour time frame. Okay, we saw price rally up sharply. We have a bullish order block in here, price rallies away, dips back down into it again, and we're able to capture this move, okay, using the tools. Again, I'm leaving out this because I could make the case, because I actually did this trade in a live account, but there's other indications back in here that you could have used on a higher 4-hour and daily chart to understand what we did here. That's not the point of this installment here. But you have another rally in price. Again, focusing on what? The bullish side of the marketplace, because we're in a weekly bullish order flow. It's 127 pips right there. We have another bullish order block. Okay, right in here. Didn't quite get into it. And we started consolidating. Now this is something where if you see this, you see a price rally out like this, starts consolidating like this, okay, the first thing you want to be questioning is, okay, where's the stops? Because that's the next thing they're going to be doing. They're going to be looking for where to run out the participants or suck them into a long period of correction. So there's stops above the market, and there's this low right here. So everyone that's long is going to be looking at this low and this low to be anchoring their protective stops. There ran, okay? But we have this range from this low up to this high with this bearish candle as the bullish order block. We're going to drop that there. Price comes down right into it, works around that level, okay, and eventually goes into another consolidation. We learned in the Sniper series that we look for a raid, ran stops, and then move lower. Okay, so there's really nothing in here to indicate any kind of bullishness. Even though that we dropped down into the level, we didn't see the rally outside of this here, because again, I could say, well, look, we have it, okay, because this is the bearish candle prior to the move higher, and we dip back down into it. But again, I disqualify this because if it's a long wick like that, I don't like that. Okay, I want to see a big bold body candle. Okay, it can have a little bit of a wick, but I want to see the majority of the candle be a body, something like this here. That would be indicative of an ICT bull order block. But because we had this big long wick, even though it did dip down, and this could be argued it would have been profitable, this is not a trade that I would see using the tools and outline as we have been discussing. Okay, we have price come down, rally off, dip back down into a nice order block in here. Okay, rallies up, and we have an order block here. We did get that one. Okay, rallies off again. And actually there's several of them in here. If you just go through and look at it, there's many of these scenarios where you can catch, what is that, anywhere between 25 and 40 pips each successive retracement back into a previous order block. Okay, and this moving forward, I'm going to speed this up a little bit because we're spending a lot more time than I wanted on this module. We have a bullish order block in here. Price comes down to it, rallies again, rallies again. Okay, we have bullish order block here. Prior to the rally up, it dips back down into this order block, rallies up. Okay, that's another 50 pips or more rally in here. Okay, yeah, that's too much of a wick there. This one's nice in here. Price rallies away, comes back down into the previous order block, rallies up. Just this move alone, that's 32 pips right here. Again, you know, in the right hands, it's simply, amazing what you could do with that type of move over and over and over again consistently. We have a nice bullish order block right here. And yes, there is a wick here and there's a little bit of wick here, but majority there's a lot of body in there, which is what I like. I would use that as a bullish order block right in here. And this one, even though we do have a sharp uh, reversal and slam lower, we had 60 plus pips that made available. Okay, running out of previous high an area to take a trade with. And let's scroll through a little bit faster here. So a lot of real quick snaps higher. We have a bullish order block here. Price rallies, drops back into it. You could be a buyer in here and up to here. So that's about 30 pips or more in there as well. Okay, and I know a lot of you, if you're anything like I was when I first started, okay, it would piss me off that if I went long in here, okay, and made money, and maybe I did get out of the profitable exit, but then it does this type of move here. It would piss me off that I didn't participate in this move. It would piss me off that I didn't participate in this move here if I was being a long around that same time frame. And my counsel to you is to let it go, man. You're not going to catch every move, okay? Nobody does. Nobody's doing it, okay? There's no superstar trader out there that's catching low, high, low, high. Man, come on. That's unrealistic. Nobody's doing that, okay? Nobody's doing it. You might get a hot lick in the market where you're catching this and that, but you're not on a level of every swing high and every swing low. You're not getting that, okay? And you don't need that. You just need a small segment of the marketplace over and over and over again that you constantly go back to and harvest. And that's all you need, okay? Here's a nice little classic scenario here. Price comes down, rallies off sharply, doesn't spend much time down here. Here's your bullish order block, comes down into it very handsomely, being a buyer here. Okay, and moving forward, I think that's pretty explanatory right there. We have a nice bullish order block here. Price rallies off, comes back down into the order block right here, and one more time here. Okay, and I think this is pretty agreeable in terms of aggressive move higher. Okay, and again, that's what I'm trying to indicate. Yes, we have these little drops down and little drops down here. Okay, if you're short, that's wonderful. Okay, but this is what I'm looking for. This is what I'm hunting. That's what I'm trying to get you to look at. If I could take my perspective of the marketplace and take it out and clone it and put it in a way where you guys can download it, I would love to be able to do that because it would, well, first of all, it would make my job easier as a mentor, but it would make your job a lot easier also because you would know specifically what it is that you're trying to filter out and what you're specifically focusing in on. Okay. And again, we'll just scrub through and you can see going through, there's many opportunities where the marketplace gives you several buying opportunities. Like there's one in here, this larger order block here we dipped into, came all the way back down into it again. We have this order block as well where we drop down into it. Look how aggressively it moved lower. Okay. When you see this, I guarantee you, if you're watching this on a 5-minute chart, this is scaring the hell out of you. If you're long, you're getting out. You're not going to stay in that. You're going to be looking for it to continue to go lower. But what is it doing? It's rapidly getting down to an area of where liquidity rests. There's a large pocket in this area, okay, because they did their buying here. It rallied off, came back down, okay. I'm dealing at a bank. I need to move currency. Right now, there's simply not enough buys in this area, but there's a large pool of willing buyers down here. Are they looking at Oanda? Are they looking at FXCM buyers? No, they're not. Okay, they're looking on the bank institutional level. Okay, who's willing to be buying down there? Okay, so they're going to take price and reprice down to these levels, knowing that this is where the liquidity is. And because their interest is so vast and large, when it gets down here, it doesn't spend much time. It takes off and rallies. Okay, because their blocks are a lot larger than we could ever imagine on a retail level. The price continues to move higher. And again, we have multiple opportunities where order blocks are being respected. Okay, and it's an exercise that you need to do on your own, going through the charts as we just did here. Again, maintaining the level of observation that we're in this shaded area still. So in other words, we're focusing only on the buy side. Okay, we're only looking for opportunities where bullish market orders, order blocks rather, are clearly seen, then being respected, and then rallying off. Bullish order blocks being respected and rallying off. Okay, you can watch any video course out there, you can watch any mentor out there talking about what makes the market move around, what does this and what does that. Okay, but I'm going to tell you right now, if they don't have this understanding behind what it is that they're doing, they're just blind luck. Okay, because without institutional sponsorship behind price moves, we have nothing. Retail market traders do not move the marketplace. You have to be positioned on the heels and coattails of those participants that have the number one, the cash flow to be able to move the marketplace, and also to have the brains behind the whole move. Okay, so hopefully it's been insightful to you guys, and I wish you good luck and good trading.